ICT Daily Bias is one of the most important concepts you need to know to become a successful ICT trader. But most traders don't know how to implement it correctly. In this video, I will go over my 4-step method to help you improve your daily bias and get results like this. Before we begin on the 4-step method, what we want to do is we want to make sure that we are on the daily time frame and that we are showing at least the last 6 months of price action. So currently I'm in August and I'm showing up to November, December last year. Step 1, mark out recent liquidity sweeps. So what we're looking at is recent price action, and we're going to look for and see if we've had any recent liquidity sweeps with this price action. As we can see, we've had this move up and then we've had this move down, but it hasn't taken out this low here, and this low here isn't as significant as we want it to be. We essentially want it to be a peak or a trough essentially. So what we're going to do is we're going to look at this move here and see if this has a recent liquidity sweep. If not, then we'll be looking at this one and going back like that essentially. So if I scroll back a little bit, what we can see is very clearly that this high here has taken this high here, which is basically the liquidity sweep that we are looking for. So let's just mark that out on the charts very simply, like so. And then I'm just going to mark it with this, which says recent liquidity sweep. Step 2 is to mark out the resting liquidity in the opposite direction. So as we can see, we have a recent liquidity sweep in the direction of to the upside. So we want to find and mark out resting liquidity to the downside. So if we look at where price is now, we're going to look at where is the resting liquidity marked out. So firstly, we can see we have this low here, and that's going to be the first place we're going to mark out the resting liquidity, and then I'm going to mark it with this. I've marked it as green because it's a target, because we expect price to move into that direction. Now I'm going to go for the next one and the next one. So as a maximum, you don't want to be drawing more than 2 to 3 resting liquidities, because you don't want to plague your mind with too much to essentially consider when we're building the story of where the daily candles are going to move next and where the daily bias is. Remember, we want to paint a simple picture to understand where price is going to go, so we can then take trades and trade our systems in those directions to get the best results possible. So now that we've marked this out, what can we clearly see? So we can clearly see price has taken the recent liquidity over here, and it's pushed down, and we have resting liquidity here, here, and here. So now what we got to do, and step 3 is very simply, we're going to mark out any fair value gaps and order blocks that we can see, especially with recent price action. We're not going to go as far back as this, there's no need to. We want to look and mark out recent price action. So when we move in closer to here, what we can see is in this move to the downside, we have a very clear fair value gap just over here. So I'll mark that out there very simply, and then we are going to look at where price is currently. So as we can see, we've moved down, but we have some sort of reaction here. Now you don't have to mark out this fair value gap, but I'm going to mark it out because we're having some sort of reaction, and it can be significant if we end up moving to the upside from here. Next, we're going to look lower. We can see we have a fair value gap over here. Let's just mark out this one here. I'm not going to mark out this one because price already reacted to it, as we can see, and pushed away. So we can essentially say that's mitigated. And then we have one very clear one just here. So let's mark that one out as well. Very nice. So now that we've marked out fair value gaps, let's have a look at to see if we have any order blocks that we can look at. So actually looking at where price reacted from, and it's always good to do this as well to see where price is reacting from, and if it's reacting from a fair value gap or an order block, we can clearly see price has reacted from what seems to be a fair value gap. But if I just put my cursor here, we can see it's tapped into this candle here. So what I'm going to do, and this is probably the only time you're going to move down a time frame, is just to see if there was an order block just over here. So the price action's there. It looks like we do have an order block here. So what I'm going to do is I'm just going to mark this out with 2 lines like so. Let's just do them as red, this one as well as red, just to know it's the order block. And if I jump back to the daily time frame, or actually let's go back to the 4-hour time frame just to see, is it respected? Yes, it is, very nicely as well. And let's just go back there. So now we know that price, when it ran up and took this liquidity over here, it tapped into an order block, filled this fair value gap that was left behind over here, and then it moved to the downside, which is very, very promising. And now we can start to see that we are building some sort of story of where price has gone, why it went there, and why price has come to where it is now, and where we can expect it to go. But before we do and we start to look at and build the picture properly, we've got one more step, which is step 4, which is very simply mark out the equilibrium. So you're probably thinking what the equilibrium is, and very simply, the equilibrium is the middle price. And the way we're going to get that is we're going to get our Fibonacci tool. We're going to go from the significant recent low to the significant recent high, like so, and we're going to mark it out very, very nicely. Now what I would say is, when you're doing this, is as you can see, I drew my Fibonacci from the low here to the high here, but what you want to do is take this and use the magnet tool to make sure it's accurate. So as you can see, my Fibonacci tool before showed 724, now it shows 719. So very simply, once you've done this, get a line tool, put the line exactly on it, and is it bang on? It's 715. So that means I need to go into here and type in 719. We want to be as accurate as we possibly can. So now that we've done that, we can get rid of our Fibonacci tool, and now we have equilibrium put into place. And this is super important, because if we look at how price is respecting this line, we can see price tapped off it very recently, and if we go back, we can see we've got wicks into it, price is closing and then moving away, rejecting it, bouncing off it, and this keeps going back as well. So we can see this is a significant price level that price has come to. So now that we've got step 1, 2, 3 and 4 out of the way, we can start to build a picture of where price can go, why it can go there, and give ourselves a probability setup. If price does this, we can expect this. If price does this, we can expect this. So let's dive into that straight away.
Top.
Okay, so let's have a look at what stories we can build with the price action we have found and from the things that we've marked out on the chart. So very simply, we can see that price is reacting from this fair value gap over here. We have a fair value gap over here that hasn't been mitigated yet, and we have resting liquidity to the downside. So one idea I'm going to come up with is we can think that price is likely to move from where we are now to the upside, tap into this fair value gap, and then possibly move to the downside and start to take out either this resting liquidity and then move back up. So that's one idea we can come up with, or it goes deeper, reacts to this one, give us some sort of structure, then moves back to the upside. Or we can have a deeper retracement, and I've just noticed that I haven't marked out a fair value gap here. We actually have one just below, which looks like a very cool fair value gap that price can come into, having taken all of this resting liquidity, target 1, 2 and 3, tapping into it and moving away. So something very simply like this, comes into here, and then moves back up to the upside. And the reason why I'm looking for moves to the upside is if we look at price action recently, it's been moving to the upside since 2022. We've been having these long moves to the upside. So such a retracement, like from here to here, we can expect to here for price to continue to the upside. So that's one theory. The other one is we can literally just break up to the upside and continue moving up, as we've had higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, and price is trending and it is bouncing off that equilibrium line. Now the reason why we put this equilibrium line here is because we don't want to be taking buys from above the equilibrium, and we only want to be taking buys from below the equilibrium. So because all of these resting liquidity and fair value gaps are below the equilibrium, we're happy to take buys here. And again, and vice versa, we want to be taking sells from above the equilibrium line, because that's where it makes more sense and that's where it would and should be taken from. So now that we have a good idea which direction do we think price is actually going to go in, now very simply, we will never know 100%, but what we can do is we can improve the probability by taking trades in the direction that we see price ending up moving in. So if price starts to move to the upside like so, like this, right, what we can do is in our systems and strategies on the lower time frames, we could be looking for buy trades up until this point here. Then we wait for the reaction. We don't have to take the trade to the downside from here. We don't have to do that. Just wait for the reaction, and once we start to see price move to the downside, take your system trades to the downside and take your strategy trades to the downside. And then again, when we come to these areas, just wait for the reaction. Once the reaction comes in and we start to see price move to the upside, that's when you start to take your trades to the upside. Same thing here as well. Don't try and trade the reaction. You don't have to, especially when you're doing daily bias. Wait for price action to show you its hand in which direction it wants to go in, and then you take the trades in that direction. Thanks for watching, and I'll see you in the next video.